Presidential terms and market volatility. Let's take a look at where the team went with this. Our last election piece, we looked at 2016 to 2020 and 2020 to 2024. We looked at SPY short strangles because we're looking for stuff to do today. We looked at the success rate, the premium collected, everything else. We compared the results across the last two presidential terms, the 4 years of Trump and the 4 years of Biden. We used the implied volatility rank to gauge option prices. It reports expensive options near a 35% reading when IV is near its highest level of the year. In this study, we aim to explore how varying volatility levels have influenced market conditions across past presidential terms. Interesting. This table shows the frequency of each volatility level. Now, again, we're looking at 1 year, 23 to 24, then 2016 to 2020 and 20 to 24. So covering all the bases here. And the percentage of time the VIX was in, different ranges. In the Trump administration, the first one, it was weird. We got down 7% of the time the VIX was under 10. Never happened under Biden, never happened in the last year, of course. And the funny thing is that when you look at the rest of the numbers, they're not that crazy. Volatility's been a little bit higher since the pandemic. Yeah. A lot of people think that under Trump, we had these crazy volatile times and all this other stuff. But the reality is we didn't really.
No, it was business as usual, just like every other president.
Right. Most of the time, 63% of the time, volatility was in the crapper. It only rallied a couple times under Trump. 2020, we did have the pandemic built into there. So when you look at 2023 to 2024, 87% of the time, we did nothing. It was kind of a very weird, slow time. And then in 2020 to 2024, the whole picture, it kind of broadened out things a little bit more. And you can see over the last 8 years, we have not had, 1% of the time, 1.8% of the time total in the last 8 years, the volatility has been over 40. And only 13% of the time it's been over 30. This is where we live most of the time. In recent years, implied volatility of the S&P 500 has ranged between 10 and 30. That's very fair. This period has been marked by relatively low volatility, which suggests that selling options when the IV rank is low may not be ideal. Waiting for high V rank over 30 to initiate trades also may not be practical, as we've observed IV can decline and remain low for extended periods. Given this, should we consider a more aggressive approach? So this shows the results across different IVR environments for 4 years from 16 to 20. And we focus on the 0 to 30 range as it appeared more frequently in recent years, and it serves as a useful comparison. So the success rates don't really change that much between 10 and 20 and 20 and 30. The average P&L obviously surprises me because I think that it should have been better. And the return on investment is between 10 and 20 just because we stayed there most of the time. I think that's the real reason. But none of these numbers, the success rate's good. The numbers don't jump off the screen at me as anything much. Let's look at a different time period. So we look at 20 to 24. This is a lot more interesting because we actually had slightly higher volatility, as you remember. The success rate's a little higher. The average P&L is dramatically higher. The return on investment is dramatically higher. The premium is much higher, and the buying power required is also higher. These numbers are a lot more interesting. And the takeaway from this is that we had much higher volatility post-pandemic. I don't think it mattered that it was Trump or Biden. I think it mattered that it was post-pandemic and it took follow through for a couple of years. But you can see
I agree. I wish you could point to administration and say that it was volatile one or the other, but it really wasn't.
No, I think this was more of a meme stock thing and then a pandemic thing than anything else. So yeah, I think totally I guess the kind of some of the takeaways here is it's hard to predict based on a certain candidate how high volatility is going to be. Because I just don't think it's that easy. And again, it's hard to predict what kind of unknown events are going to happen. But higher volatility definitely leads to better returns. In comparing the two different terms, we observed the following impacts. The average profit and loss increased by more than 3 times on average in the second term. The premium collected was up 2 times. The return on investment rose up to 3.5 times, and the buying power only increased by 1.5 times. So just making the argument, not making the argument that trading is better under a Democratic administration, making the argument that trading is better under a higher volatility.
Most
and trying to say that it really has nothing to do with who is the president. It has to do with, what happens and where's the volatility. So some of the takeaways when we look at these two presidential terms, the last two presidential terms, high IVR presents ideal opportunity for selling options. However, reaching those extreme levels is very rare. Recognizing that volatility often clusters at lower levels, we should consider being more proactive sometimes. Okay, not always, but sometimes. During the last two presidential terms, we generally saw low volatility levels. By adopting a more aggressive approach and managing positions early, we're able to increase profits and collect more premiums. And that was an across the board message. That's generally the case when volatility is low.